Good afternoon and welcome to Scotia iTrade's webinar. My name is Conleaf, the Client Education Specialist with Scotia iTrade. I'm pleased to present to you today ETFs 103, Building an ETF Portfolio with Horizons ETFs. So just before we get started today, we're going to take care of some housekeeping items and then we'll jump right in. So your sound quality should be good. However, you can check this quality by clicking the sound check link in the audio panel of your GoToWebinar toolbar. Now, the setup window may be on your secondary screen if, in fact, you're using two monitors. Also, just be reminded that everyone will be muted for sound quality purposes today. And if you're using your computer audio and you're experiencing any audio issues, you can always switch over to telephone, give us a phone call via the conference number on your toolbar. Just don't forget to use the access code and the audio pin ID. Quick disclaimer for you today. Unless otherwise expressly stated by Scotia iTrade, seminars, webinars, and other educational tools and resources, collectively called the content, are provided by independent third parties that are not affiliated with Scotia Capital Inc. or any of its affiliates. Scotia Capital Inc. and its affiliates neither endorse or approve nor are liable for any third-party products or services, content, or any loss arising from the use of the content. So just keep in mind as we go through the webinar, the information that we're presenting to you today will be for educational and informational purposes only. So let's quickly review the toolbar's feature. The orange arrow that you see at the top of the toolbar can be used to minimize or to maximize the screen. Simply click on it if, in fact, the toolbar disappears. Also, you can view this presentation in full screen mode by clicking on the computer icon in the GoToWebinar toolbar. Lastly, you can always raise your hand. There's a hand icon there in the toolbar. If you've got a question or a concern, just keep in mind, though, I will be monitoring the question panel box. So if you've got a question, just type it in right there, and we'll be able to address that. Now, the presenter may elect to answer the presentation as they go through, or they may elect to leave it to the question and answer session at the end of the presentation. So today's session will be recorded. A link to this recording then will be emailed to you by mid-afternoon tomorrow, or failing that, you can just email me at education@scotiaitrade.com and I'll send a copy of that out to you. Also, you can visit our YouTube channel. We've got a webinars on demand playlist there where you can actually find our archived webinars. Just go through, search through that. The link is on the scotiaitrade.com website. The presentation that you're going to be seeing today, a copy of this has been provided for you. A PDF file of this presentation has been provided. Simply click on your GoToWebinar toolbar in the handout section, and you'll see that a link has been provided for you there. So if you'd like to download that and to kind of go through that as the presenter is presenting, you can make notes as well there. So today's session is brought to us by Horizons ETFs. They've got a learning series on. Now, I've got on my screen here ETFs 102. In fact, what we're doing today is ETFs 103, Building a Better Portfolio Using ETFs. Now, if you've missed any other webinar in the series here, you can go to our archived webinars on YouTube and get those archived webinars there, or just email me at education@scotiaitrade.com, my apologies, education@scotiaitrade.com to get a copy of any presentation that you may be missing. And what we're intending to do then is to kind of go through the series over the course of the coming year. So just stay tuned to your events calendar on the events education page for more of this series. So today we've got with us Mark Noble, who's the head of the Sales Strategy, VP Communications, and Public Relations. Mark has been with Horizons for more than 7 years. He's responsible for its external communications and sales strategy. He's a strong proponent of financial literacy and ETF education, working closely with the Horizons sales and marketing teams to build out the client educational tools and initiatives and help Canadians become better ETF investors. Prior to this, he was a personal finance journalist at the Advisor Group, which is a leading financial publication firms serving the Canadian financial advisor market. So at this point, I'm pleased to turn the presentation over to Mark, who will facilitate the session for the next 30 to 40 minutes. Mark, over to you now.
Perfect. Thank you so much, Conleif. And as always, it's a real pleasure to be with everybody here this afternoon. Just earlier to what Conleif was saying in terms of there being two previous presentations, hopefully that doesn't make this too daunting for you. In fact, what I want to highlight is that we will go through just a quick refresher on ETFs. So even if you haven't seen the other two presentations, please feel comfortable following along here today. I don't think there's anything that should be too complex for you to take a look at. But as the name of our sure, I'm just going to put it on a full slideshow here. There we go. Where are we here? As the presentation's name implies, it's called Building a Better Portfolio Using ETFs. So what we're trying to do here is provide a little bit more education on how to go from the idea of wanting to be an ETF investor and somewhat understanding what ETFs are to actually constructing portfolios using ETFs. Now, as you can appreciate with a 45-minute presentation, we're not going to be able to get to everything. This is obviously a lifelong learning process on how to build a portfolio. But what I'm hoping is that through this presentation, which I've given a number of times, we can create some of the basic building blocks that allow you to maybe set up portfolios that work a little bit better for your goals and risk return objectives. So our agenda is fairly simple. We're going to go through briefly what is an ETF, just so we all know what we're referring to and some of the key aspects of ETFs. Then I'll talk about the very important process of asset allocation. We'll talk about fees, types of ETFs, and then some of the key considerations for the types of ETFs you can purchase, as well as then at the end some trading tips, in which case we'll also go through Scotia iTRADE platform and hopefully look at a couple key important details when it comes to buying and selling ETFs. So let's start with what is an ETF. You're obviously here because you want to learn more about ETFs, and I find that even though ETFs are well written about, and there's things on the ETFs on every day in the Globe and Mail and BNN, and every personal investment book seems to have a chapter on ETFs, they're actually not that well understood in terms of what they actually do. ETFs are really at their core a type of technology similar to how an MP3 would deliver music the same way that 35 years before that records did. That is the same concept behind an ETF. An ETF is actually a made-in-Canada invention. The first ETF started trading in 1990 in Toronto Stock Exchange, and the idea was to create an open-ended investment fund, so effectively a mutual fund, something that can be bought and sold that has a number of securities inside of it. The first ETFs were stocks. But unlike a mutual fund, which you can only buy at the end of the day, it trades like a stock. So just like looking up, ROI for Royal Bank or TD for TD Bank or APBL for Apple, you can find ETF tickers that give you these exposures to these various asset classes and groups of securities. Historically, ETFs track a well-known passive index or benchmark, and in fact, of the $4 trillion now that we see invested globally in ETFs, still $3.5 trillion of those assets are still in what we would call passive index or benchmark, meaning that the ETFs give exposure to a benchmark such as the S&P TSX 60 or the S&P 500, where there's no active manager actually trying to generate higher returns by outperforming the market. Instead, they're simply trying to generate the returns of the market, which are represented by those benchmarks. And we'll get more into that later. So to really understand why the ETFs came about, you need to understand how mutual funds work. And really, mutual funds, just like I use the example of a record, are a fairly good delivery mechanism for what they do in terms of giving people very low cost and broad exposure to a group of securities. So when mutual funds first came onto the market, I believe it was in the 1920s, the idea here was to give investors of all levels the ability to invest like wealthier investors. So wealthy investors, of course, could build a diversified portfolio of stocks, but that would be very expensive. Mutual funds basically pool all of those resources and allow other investors to have diversified exposure to a portfolio of stocks. We know that owning one stock is a fairly risky proposition. It fits with that old adage, don't have all your eggs in one, but don't have your eggs all in one basket, or in this case, one egg in one basket. You want to have diversification across a number of securities. So that's really the aha moment for mutual funds, and the reason they became such a popular delivery mechanism for investors is they provided diversified exposure, professional management, and over time was probably the best investment wealth creation tool for the majority of Canadian investors. ETFs are a similar sort of strategy, but with a fund company, it's a fairly simple process. You either go through your online broker like iTRADE, or if you'd had an advisor, you call your advisor, works directly with the fund company to build new units of the, we'll take an example of a stock mutual fund, goes to the market, purchases the stock, and then delivers those to the buyer. And if you sell, it's the same process again. Fund company sells and destroys the units of the mutual fund, and the cash goes back to the seller, cash proceeds. Fairly simple. The fund company is doing most of the work for you in terms of building those units. So you put your order in, and the fund company over here is the one who's doing most of the work, working with brokers and the stock exchange to build those units to give to the buyer or the seller. Now, the reason I highlight how the mutual funds is because the same benefits of ETFs are effectively what we were trying to achieve with ETFs. It's just that ETFs have to trade on an exchange, so there's a slightly different structure. So ETFs take the same concept of mutual funds, which is to provide diversified exposure to a portfolio of securities, but they're trying to do it at a lower cost and in a more flexible way through which you can purchase throughout the day on an exchange. So instead of dealing directly with the mutual fund company, you're actually doing a lot of more of this yourself. So ETFs trade in what we call the secondary market. The secondary market would be buyers and sellers working through a brokerage, their different brokerages accounts, through an exchange to buy and sell from each other. So instead of where we have up here originally being the mutual fund, the buyer works through the exchange to buy or sell their ETF units either from other sellers or from another party called an ETF market maker. And this is a large capital markets group that's at arm's length of the ETF provider. So someone like myself who works for Horizons ETFs, we produce the ETFs and we have them available. The ETF market maker, however, is a large trading group, usually with one of the big 6 banks in Canada. They go and they build new units if not enough units exist between the exchange for buyers and sellers, or sometimes these market makers have inventory of themselves and exchange directly. To use a sort of a pedantic example, this would sort of be like eBay, right? In terms of buying and selling from each other, as opposed to buying and selling directly from a mutual fund company. And so then the ETF provider, if it needs to create new units, it'll build those units with the market makers who will purchase them and then go into the exchange and sell them. By doing this, it does two really important things. One, it allows ETFs to trade on the exchange throughout the day, so you have intraday liquidity. And number two, it also ensures that ETFs, and this is really, really important, ETF's value of the ETF is reflective of the underlying value of the securities it holds. So if the cumulative value of the 60 stocks in a TSX 60 ETF is worth $20, therefore the price of the ETF should be close to $20. So this market mechanism of always being able to create new units ensures that the value of those ETF units reflects the underlying value of the securities. Okay, that's our brief on ETFs, and really again it's a technology. What you put in an ETF is very diverse. In fact, it gets more kind of crazy by the day. But at the end of the day, what ETFs do is provide that diversified exposure, but transact liquidly on an exchange, and usually at a low cost. So we've talked a little bit about ETFs, and I'll get into fees and some of the other mechanisms of ETFs later. But I want to take a step back here because doing this as long as I have now, working with direct investors, I sometimes find that we get talking about ETFs, and people want to hear about what ETFs to buy, looking at what ETFs would be the right for their portfolio, and they really tend to miss what is the most important portfolio decision. So, I usually throw this question out if I'm working in front of a group to say, what is the most important portfolio decision you can make? So this isn't talking of, we've got a pot of cash and you need to build a portfolio. So, the question I ask, is it to find undervalued securities? Is to buy low fee investments? Should you be investing in more real estate? Maybe you want to find investments that earn a high income. Maybe forget all that and hire an advisor to do that for you. You know, the answer is really none of the above. I mean, these are all important considerations, and certainly we spend a lot of time in the financial media and in financial literature talking about them, but these are really, at the end of the day, not the most important investment decision. The most important investment decision for your portfolio, after, I guess, you know, determining what it is you want to do with the money in your portfolio, is creating the proper asset allocation. And I can't stress this enough. So for the next 3 slides, if you learn anything in this presentation, this is the part where I really want you to pay attention, because it is crucial. And really, I work with direct investors with $10,000, and I work with institutions and pensions who have billions of dollars. But everything they do, everything we do as investors, success comes down to this, which is asset allocation. So I've put the great Gary Larson up here on the slide to show his cartoon, which is saying very simply, you get up in the morning, remember, first pants, then your shoes. Well, investing, that's the same thing here. First asset allocation, then looking at security selection. And the reason for this is because the idea of what asset classes to own is far more important than how you get exposure to them. So I'm an ETF guy, and I'm going to tell you right now that making the wrong asset allocation decision and moving to ETFs and making the wrong asset allocation decision is worse than staying in mutual funds or stocks that are providing the right asset allocation for you. So the idea here is whether to be in stocks and bonds is a much more important decision for you as an investor than the idea of buying a stock ETF versus a stock mutual fund or individual stocks. And I really want to highlight that for you, okay? This asset allocation is the single most important thing you're going to do in terms of determining success for your portfolio. And you don't need to just ask me about that. In fact, this is probably one of the most cited studies in investments over the last 30 years. And so in 1986, a group of well-known financial academics came up with a study, and it's called now Brinson, Hood, and Biebauer, or BHB, or BBH, however you want to refer to it. And the idea here was to create, look at really what drives performance in a portfolio. And what these 3 academics found was that 91.2% or 91.5%, I guess is what this is showing you, of your returns come from variability of returns come from asset allocation. That is, what drives the returns in your portfolio, the differentiation of returns, is how you diversify the portfolio on an asset allocation perspective. So most of the returns, or 90% of what drives your returns, are going to be from what asset classes you select. So that'd be the idea of stocks, bonds, commodities, cash, rather than how you get exposure to them. And you can see the second most important one is the actual security selection, but that's only 4.6% of your return variation versus 90% for asset allocation. And then, of course, things like timing are about 2%. So timing really doesn't matter as much. Being in the market, obviously, is much more important. And having the right asset allocation is much more important than how you determine what stocks to own. So the idea here being, if you were to talk to Brinson, Biebauer, and Hood, and they put TD and RBC in front of you, and you had to pick a stock of which one to pick, they would say really at the end of the day, because they're both large cap Canadian equities in the financial sector, and more specifically the bank sector, picking either stock over time really wouldn't make a huge difference. I mean, one could, I guess, run into financial impairment, but generally speaking, those 2 stocks would probably deliver most of the same return over time. One person, of course, would outperform. The person who picked maybe RBC outperforms TD over a 10-year period, but over time, as a proportion of a portfolio, it wouldn't make a huge difference. The idea to have been in financial stocks was much more important than which financial stocks you choose. And so that idea comes over into how we look at ETFs. So I'm going to talk about all these different types of ETFs. But again, buying ETFs is absolutely useless if you don't have a good asset allocation. So I want to highlight that. And if you have a good portfolio right now and a good asset allocation using mutual funds, you've already done 90% of the work there. Really what you're doing now is looking at this other 10% to maybe fine-tune it by lowering costs or getting more liquid exposure through ETFs. That decision's up to you, but I really want to highlight that. So then that asks the question, what is the right asset allocation? And I'm going to come out right now and say, I don't know. If I knew, I probably wouldn't be doing this right now. I'd be sitting somewhere in probably not the Caribbean because of hurricanes. So I'm going to take the South Pacific. But no, I'd be enjoying myself on a luxury pad. But no, I mean, look, there's really the right asset allocation. The answer to this is, again, what is it you want to do with your money? Obviously, different types of investors have different risk return goals, and establishing those is the most important thing. If you have aggressive return goals over a shorter period of time, then you're going to have a riskier portfolio. But generally, older investors, and we can say this as a generalization, and I would say these are for investors 60 years or older, have less time to recoup losses. So they should have a lower risk profile than investors with a longer time horizon. And really, the real idea behind this is that as you get closer to retirement, more of your portfolio becomes income, so you need to have a more conservative asset allocation because if you have a huge loss similar to the financial crisis, that takes years off of the longevity of your portfolio. So, losing 40% at the age of 35, not a big deal. Losing 40% at the age of 65, that's a pretty big deal. So we do know that generally older investors should probably have a lower risk profile. Fortunately, most Canadians are living longer, well into their 80s. So, you can take more risk as a 65-year-old today than you could have, let's say, 25 years ago, but you still need to take, stock of how long your portfolio needs to last and therefore move it to more of a conservative portfolio. Up until about the age of 60, most data asset allocation strategies, and I think you'll find this really interesting, if you look at the models that are put together, whether you use a bank branch or model portfolios that are recommended by brokerages, you'll find most of them use a target asset mix of about 60-40. And when we say 60-40, it's a financial term we use in our industry. What we're saying is 60% stocks and 40% bonds. And generally speaking, that ends up being sort of the standard allocation that an investor with an investment time horizon of 15 plus years gets put into. And there's a whole range of statistical reasons why that is. One of them is, generally speaking, it's worked pretty well, to be quite candid with you. That generally means that you have 40% of your allocation with bonds that tend to do better in a declining market, and obviously 60% in equities, which tend to do well in a rising equity market. As more Canadian investors are getting older, I'm seeing a lot more 50-50 portfolios, but the idea remains the same. Typically what it means actually, if you get down to the math of it, is that the bond allocation usually represents, the equity allocation usually represents, the number of years you are as an investor, although I would say most investors in the 45 to 60 range get put into the 60-40. So I mean, if you're 60 years old, you probably want to be 60% equities. And we could argue about this all day long, but that's what really, when people talk about 60-40, they're talking about these strategic asset allocation models. Now, if you have an immediate need for income, obviously a shorter investment horizon, you'll likely own a greater proportion of lower risk bonds, and your stocks will probably have more of a dividend bias and more of a conservative bias. Here's the problem with 60-40 investing, and again, I said it works pretty well, and you can see on this chart actually, and I'm going to explain how this chart works, that it does work pretty well. If we look at this line here, we see that over time the standard deviation, when I'm talking about standard deviation, I'm saying the movement from losses to gains, so how volatile the portfolio is, tends to be fairly constant, right? So if I'd had a 60-40 portfolio, I do pretty well actually over most market conditions. The problem is that through a full market cycle, through the lifetime of your portfolio, you're not going to be in what we would call normalized market conditions. Large sell-offs do happen. So here I have a 60-40 portfolio, and so if I'm an investor, and I'm going to use the highlighter here, if I'm an investor here in March of 2002, and I have to transition my portfolio from 60-40 and start looking at income, not so bad. There's a bit of a drawdown here, but most likely as I move my portfolio to more of an income focus, I'm probably okay. Hooray, retirement, great. Now if I'm an investor who's 8 or 9 years younger, and I find myself in this particular sorry, and then I find myself in the same situation 5 or 6 years later. Not so great. This is the global financial crisis, and we can see that the standard deviation of this portfolio went off the charts. It went 25%. 25% standard deviation means you're probably losing about 40%. That would be a real cruel fate if I was an investor who was having to transition to retirement during this particular phase, because I would be moving more to income investments, which have done reasonably well, but I'm losing out on that huge 200% return we've seen since March of 2009 at the lows here. So as a result, you know, I've lost years of my portfolio. So that's a real cruel fate. And so it is important to understand that while the 60-40 allocation is usually a good measure, most stats bear it out, it doesn't do the greatest job at managing risk. And there's a lot more literature coming out, both in academic and industry circles, suggesting that maybe 60-40 portfolio, while it's a decent guideline, it probably doesn't address the idea of diversification as well as we'd like. And the reason for that is because what we're finding is as that more money comes into the global capital markets, when I'm talking about capital markets, I'm talking about everything, stocks, bonds, commodities, there's always more money coming into it. And part of that is because we're seeing the middle class grow around the world. For example, in Asia, for example, the middle class has pretty much doubled, almost tripled in the last 15 years. So there's more money coming into the global capital markets. And as more money comes into the global capital markets, it starts to chase the same sort of assets as everybody else. And what we can see here in this portfolio is that actually, regardless of what you buy, most of the major asset classes tend to move fairly similar to the same direction. Now, generally, again, if you go back to my first point on asset allocation, we can see that equities tend to move pretty much in tandem regardless of where you own them. So if I own the NASDAQ 100, which is technology-focused stocks, you know, with Apple and Google and Facebook, that moves almost in lockstep with the global stock market. So really, over time, owning these two has not really been a whole lot of difference in terms of your returns. Same thing if I own Canadian stocks. You're not really getting a whole lot of diversification by owning these. Now, these are, you know, all kind of move in tandem, which is why when you read on the newspaper that the stock market is down one day, it's very rare to hear that some stocks are up and others are down. If what you tend to hear is most markets are down on a down day and most markets are up on an up day when referring to the stock market. So the ability to diversify by owning stocks from different countries or even sometimes from different sectors isn't what it used to be. And this is particularly true in the last 15 years. So, you know, those of you who came into investing in the 80s or 90s, there was real diversification in, you know, holding the NASDAQ versus the S&P TSX 60 versus European stocks. That doesn't quite exist to the same extent today. And in fact, with all of the unprecedented amount of government money that we've seen go into bonds, you know, the largest purchasers of bonds over the last decade have been central banks. We're actually seeing bonds now start to move in tandem with equities as well. So the idea here is there's not a whole lot of things that don't go up when equities go up. We have a few here. We have gold, for example, still is a bit of a diversifier, and we have things like hedge funds and managed futures. But this whole area here, finding things like this are important for diversification, because what happens when the stock market stops going up? What happens if we end up in 2008, 2009? What's going to generate positive returns for your portfolio? And the answer simply is not as many things as it used to be, but for you as an investor, you need to find those things, because we know there's a lot of risk if we see declines in a portfolio to the magnitude that we saw during the financial crisis. And so what does a diversified portfolio look like? Well, you know, I'm not saying you can build this portfolio per se, but, you know, people are starting to move away from things like just fully owning equities. And we can see here that, for example, here's the Yale Endowment Fund, which is one of the most best performing institutional endowment funds in the world. On a 10-year basis, and we can see, you know, its equity exposure is quite low. It only owns about 4% domestic equities and owns another 15% foreign equities. So really, what you're looking at is, you know, at give or take only 20% in equities. Meanwhile, it's got diversification across things like absolute returns, natural resources, real estate. Now, I'm not expecting you to get into all of these asset classes. The idea here is remember that as you're building your portfolio, you're going to want to have a good baseline of stocks and bonds, but you also need to look at things beyond stocks and bonds. And ETFs can help with that. There are hedge fund ETFs and managed futures ETFs, shorter duration bond ETFs. So you're going to want to look at some of these other asset classes to provide some diversification for your 60-40 or whatever your target asset mix is. Now, understand as well that an endowment works in perpetuity, right? So it's not going to just turn into 100% fixed income as an investor's portfolio will at some point. So I'm assuming that if David Swenson, who is the chief investment officer of this fund, was building this for an individual, it would have a lot more equities and bonds to deal with the realisticness of the fact that your portfolio is somewhere 15 to 20 year lifespan, where this one is in perpetuity, so it needs to exist for a very long time. And so there's three different types of asset allocation that you can look at putting together. I'm not saying one's right or wrong. It's just when you read jargon, here's the kind of things that they are. The first one is strategic asset allocation. Strategic asset allocation means that you come up with an asset allocation that works as a long-term investment mix, and you just stick to it. And on a quarterly or annual basis, you rebalance. And you know what? This has worked extraordinarily well for a lot of investors. So strategic asset allocation is a very easy way for you to start in finding asset allocation that works for you, and finding a good mix of stocks, bonds, and alternatives and cash to go through. So some examples of this are actually Canadian couch potato portfolios. I have no affiliation with Canadian couch potato, but I highly suggest if you're new to ETFs, you take a look at Canadian couch potato. It's a very simplistic way to understand how to build strategic asset allocation portfolios. There's another one called the permanent portfolio of the United States. It's been run for 40 plus years. Again, no affiliation with me. I don't think they don't hold any of my ETFs. I'm just purely educational, saying maybe take a look at these. There's some ways you can build strategic asset allocation. The thing about strategic asset allocation, though, is once you decide to do this, it's hands off, okay? Really, you shouldn't be making a lot of tweaks based on market conditions. You've made a call that over the long term, you think these certain asset classes are going to do well, and therefore, you're going to just stay with them. So buy and hold, similar to sort of the Warren Buffett mantra of buy and hold. Tactical asset allocation would be the opposite of that. Tactical asset allocation would be the idea that you actually think that you're going to be able to outperform the market by switching assets on an ongoing basis. This is much more difficult to do because you can make calls that are wrong over time, but there are some investors who do well. Again, you can look at for this on the ETF side, most ETF providers have ETFs that are called ETFs of ETFs, or they're sort of like managed asset ETF strategies. You can look at these as ways to go on their websites, and these are where professional portfolio managers will manage these ETFs for you, and they're constantly rotating the ETF strategy. For this, though, you need to be very active. You need to be looking at your holdings on a weekly basis, making sure that they have things like momentum in place, that the valuations of equities aren't getting too high. It's a very hands-on approach, and the more you mess with things, it tends to create more problems for the majority of investors, but some people do very well at it. But this is a hands-on portfolio. Strategic asset allocation, hands-off. That's why it's locked. Then the final one that we see is what we call core and explore. And this is something you may actually find useful, because obviously if you're someone who's on Scotia iTRADE and you're taking investing into your own hands, for me then to tell you to build a portfolio and then walk away and don't take a look at it for 3 months is a very hard thing to do. You've taken upon yourself to invest your portfolio because you think you can generate returns that would be generated, that fit your risk return objectives. What core and explore effectively does is what the core is the core becomes a strategic asset allocation strategy. So you have the money that needs to follow a certain risk return objective over time. Again, it's hands off, but you pick the stocks, bonds, cash, alternatives that you want to hold, and then you own those. The explore part becomes the part where you want to add some value. So maybe you have some gold stocks you like. Maybe you want to have high yield bonds or real estate. So you have these other things that you are more active in picking, and those explore asset classes are usually riskier asset classes, but they allow you to be a little more active, and they can generate a lot more returns for you if you get the call right. I find a lot of self-directed investors use this strategy where you have core, the money you don't touch, and you have explore, the money that, I don't want to say play money because that suggests that, you know, it's not a big deal if you lose it, but I do call it more of strategic or tactical money, where you're looking to generate higher returns, but you can afford to generate some losses in that portfolio as you go after those sectors. So Core and Explore can be a very powerful way to build a self-directed portfolio, and Scotia iTRADE has lots of tools, analytics for you to look at on individual asset classes for which you can pick things. As we move forward and being cognizant of time here, we've got about 10 minutes. I want to look at, you know, management fees. When we're looking at ETFs, you know, one of the reasons there's been a big movement towards ETFs is because of fees. Fees are a huge differential in return over time. Here I'm using the example of a fund that has, you know, 1.6% management fee, which sort of fits in line with the standard Canadian equity fee, and I've got another fee that has a 50 basis point management fee. And we can see here that even though these ETFs generated the same return on a $100,000 investment of 4%, over a 10-year period, you have a difference of about $15,000 just from choosing the lower fee investment. Intuitively, this should make sense to you, but you know, people tend to forget this, that the lower you buy, the lower you pay for investment exposure, the better your general returns are. So investing is not like buying a luxury car where, you know, you think you can rationalize spending an extra $10,000 to $20,000 on, you know, let's say a Mercedes versus a Honda Accord or something. Both nice cars, obviously, but you know, maybe there's some value for money that you see in spending more. You don't get any extra value in money for spending extra fees on investments. Sometimes you'll see investors that generate higher returns on the higher fees, but they shouldn't be this kind of differential where you're paying, you know, over twice as much on management fees. And that's really what exists today in the mutual fund industry, where a lot of mutual funds charge almost twice as much as the equivalent ETF that invests in the same asset class. You don't get to be a hero paying your portfolio manager more money. You know, you become a hero by generating better returns for your portfolio. And the same thing becomes even more pronounced in the drawdown phase, right? When we're drawing out from the portfolio, same case here, but if we were drawing out $10,000 a year, we'd have one portfolio basically that's almost twice as much as the other, a difference of $33,000. So again, fees. This is something you can control. You can't control where the markets are going, but you can control the fees you pay, and that's a significant impact in when you move from an ETF. Now I'm going to move just to key considerations for equities. So questions you want to ask yourself before you decided on an equity ETF, and now we're taking the example here that an ETF that you've chosen fits your asset allocation strategy. So here's your key considerations. One, is the ETF indexed? When I say is the ETF indexed, does the ETF track a passive benchmark? It's important to know that, because if you're buying an index ETF, then the only returns you're going to generate with that ETF will be the returns of the underlying index. You'll never get more. You'll always get less. With an index replicating ETF, you get the index return. So I'm going to take the S&P 500, for example. You're going to get the returns of the S&P 500 minus the fees you get to that pay that exposure. So you need to know if that's something you want to do. And if we look on this slide here, we see that in Canada, 73% of the ETFs are index ETFs, and we're passive. We denote them as passive, whereas 17% are roughly active, and 11% are something what we call strategic beta, which are indices, but that indices that weight the stocks differently than other indices. Sorry, weight the stocks different than the S&P 500. They may focus on value or dividends. So the other key piece you want to look at is, does it cover the appropriate sector or geographic exposure you were looking for? Okay, you decided you want equity exposure. Great. What kind of equity exposure? You want financial equity exposure? Do you want Canadian equity exposure? Do you want European equity exposure? ETFs give you all of this, and so it's really important for you to understand what specific equity exposure you're looking for. If you don't know, then the idea here would be to, as a default, look at the large cap weighted indices. That is, if you don't know whether you want energy or Canadian equities, pick something that's diversified. So that would be the TSX 60. For the US, if you don't know, pick something that's diversified. That'd be the S&P 500. So those are easy ways for you to make a default. And of course, really, really, really important, I probably should have put this in bolded letters, is it low cost? Okay, the whole idea behind the growth of ETF investing is because ETFs on average, because they're using the secondary market system, are about 1/3 the cost of the average mutual fund, even taking out things like advisor fees. So your whole reason to move to ETFs is generally to reduce cost for exposure. Therefore, you should be looking, when all else being equal, for the ETF that has the lowest cost management fee. And that's why I say indexing is generally your best default, okay? And don't just ask me. This is actually the view of Warren Buffett as well. So a lot of people probably aren't aware of this, but obviously Warren Buffett, probably the most successful active investor in the history of the world. But he's actually made it so that when he passes on, he wants his trustee to put 10% of his money in short-term government bonds and 90% in a low-cost S&P 500 index fund. That's it. That's what Warren Buffett wants his estate investment assets in. Now, not a very good asset allocation, if potentially. I think he's probably being a little bit simplistic there, but the point here is what he's saying is he doesn't believe that if it's not him managing his family's wealth, you know, as a default, he's going to index, because over time, indexing tends to be a much better approach to how you get exposure to equities. So for example, in Canadian equities here on this slide here, we can see that, and what I'm going to explain what this means, on the top here, these are the number of, this is the index, the S&P Composite Index. So this is the broad 300 or so stocks in Canada, which you can get exposure to through an ETF. And we can see here that on a one-year basis, only 26.42% of Canadian mutual funds that are actively managed, so those you know, mutual fund managers at the banks and the large mutual fund companies, only 26% of them outperform this benchmark. Okay, on 5-year, which is interesting, is that slightly more of them actually did perform on a 5-year basis. But really, if I aggregate it out, you're roughly a quarter. All right, only 1 out of 4 managers beat this benchmark. And so you say, okay, well, there's a good number of portfolio managers that beat the benchmark then. To which I ask the question, which ones? How do you know? How do you know which manager is going to beat the benchmark? Because what we do know is that probably an investor who beats it a number of times over the last 3 years may lag it for the next 3 years, right? Particularly if market cycles change. You know, perfect example we use is of a U.S. manager named Bill Miller, who is famous for beating the S&P 500 15 years in a row, and then the next 9 years he underperformed it. So we have a term in investing called mean reversion, and generally speaking, as a default, you can see here that you usually end up being a top quartile strategy simply by owning the index for that exposure. Now, of course, there are exceptions to this. Most of them would be probably in less efficient markets, which would be like Canadian preferred shares, Canadian corporate bonds, high yield bonds, senior loans, and alternatives. With these sorts of investment strategies, you probably want to be looking potentially at some other type of strategy. And the reason for this is because bond indices are weighted quite a bit different than stock indices. So if I look on the right-hand side of this here, I can see that a bond index is fairly intuitive here in what, a stock index is fairly intuitive in what you hold here. These stocks make sense. Yes, Apple's the largest stock by market cap in the US, so that's my highest allocation. And then Microsoft and Johnson & Johnson and JP Morgan and Alphabet, which is Google. Not a bad portfolio, to be honest. Makes a lot of sense. Okay, these are definitely growing companies, and as they're growing up and have large amounts of cash, they become the top holdings in the S&P 500. Well, let's take a look at the U.S. corporate bond index. Well, this is quite a bit different. We see Anheuser-Busch as 3 of the largest lines, Goldman Sachs, GE Capital, Verizon. So what's happened here is these have been weighted by, bond indices have been weighted by the companies with the most amount of outstanding debt, the size of their debt issuances. Well, if you're a core fixed income investor, I don't know if intuitively you want to be buying the companies that have the most amount of outstanding bonds in the marketplace. It's not quite as attractive as companies that have the highest market cap in terms of their size and earnings. So that creates a big inefficiency with bonds, where if someone does credit analysis on bonds, they may be able to find a higher yield and potentially, you know, greater likelihood of outperforming, which is why when you're looking at fixed income, we tend to suggest actually potentially looking at potentially active strategies. The other thing to keep in mind with fixed income is the risk, okay? There's a lot of ETFs out there, and of course they flash their yields front and center when they're advertising. But you need to understand what they are. So something like high yield bonds, which yields about 5 to 6%, these are low quality corporate bonds. They're rated BB or below. So if you have a product that's yielding above 5%, you need to ask yourself intuitively, how is that being generated? If it's being generated on credit risk, then there's a higher likelihood of default. Now, high yield bonds, in my opinion, is a great asset class to be in, but it still stands to reason that it's higher risk than, let's say, government bonds, which are government-issued securities. Now, we'll have this slide available for you to review. I've just put it here to make sure you understand that as you get a higher yield, you get a higher risk. So as you're building your asset allocation, you need to understand the relationship between these different types of fixed income instruments to create a yield. Most investors, retail investors, try to generate a yield of about 4%. In their income portfolio, and you probably want to do that by combining all these asset classes. But of course, the goal here is to get the highest amount of yield possible with the lowest amount of corporate and interest rate risk possible. So you probably want to have a mix of all of these different types of bonds, but not overweight, high yield bonds or even overweight government bonds. You want to get a mix of something that generates sort of about a 4% return. But understand the relationship between them all. High yield bonds are lower quality, higher yield. Government bonds are much lower yielding. They're very interest rate sensitive, but they also have virtually no credit risk. The governments, particularly Canada and the United States, they're not defaulting on any treasury issuances anytime soon. Now, as we look at intraday liquidity for an ETF, this is where, rubber hits the road. It's important to understand, remember, that you can place an ETF your order any way or any time throughout the day. Regardless of where you place a mutual fund order, your mutual fund order will always be filled at the 4 p.m. price, end of day pricing. So if the market moves substantially when you try to buy a mutual fund during the course of a day, you're still getting that end of day pricing. With an ETF, the execution is almost simultaneous as soon as you put in the order. A huge differential there between the two. So ETFs have intraday liquidity. And the way that you need to look at this liquidity is to understand sort of the bid-offer spread. And I'm going to go on to the Scotia platform in just a moment, but we'll look at what the bid-offer is. So there's two fees really that you're going to pay when you buy an ETF. The first fee is obviously the management fee, which is an annual fee that you pay to be in that ETF. Over time, that ETF fee will be it's divided daily. So generally speaking, if you're in an ETF for 6 months, then you're going to probably pay half the annual management fee, right? It's accrued daily. The other fee you do pay, and people don't talk much about, is the acquisition cost of buying the ETF. So when the market makers create new units, because most of the inventory for ETFs are held by market makers, there is a commission that's paid, and that's the difference between the bid and the offer, or the bid and the ask. And most of this is actually cost of acquisition for the market maker. Obviously, there's a cost for them to build new ETF issuances. So they need to, go to the market and find those securities underlying the ETF. They have to pay their own fees. They have to watch their system. So all that has a cost. And it finds itself in the difference you pay between the bid and the ask. And I'm going to show you what that looks like on the Scotia platform here. So if I look at an ETF here, for example, I'm going to use HXT, which is our TSX60 ETF. We can see very specifically that, pull this up here, that there's a bid and an offer here, and we can see there's a difference of about 2 cents. So on that 2 cent difference, right, 70 cents over here and 72 cents over there, that 2 cents difference is a cost of acquisition. So in this case, you're probably paying somewhere in the vicinity of, I don't know, probably 5 to 10 basis points to get exposure to this ETF, okay? But what people don't tend to talk about then is they look at this bid-ask spread and they look at the volume and they say, well, I'd like to buy something that's got a little bit more volume. Maybe, it will cost me less to get in and out of the ETF. This volume metric here is actually irrelevant. It doesn't matter what the volume of the ETF is for you as an investor. What matters is what the difference is between the bid and the ask here. So on this one here, we see that it's 2 cents. You're going to pay 2 cents to buy this ETF on top of the management fee, which is, by the way, 0.03%. That's the lowest cost management fee in really North America, but in Canada in particular. If I take another ETF, the big competitor ETF for this, which is XIU, also tracks the S&P TSX 60, exact same index, I can see that it also has now volume that's 2.4 million, right? So well over 10 times the volume of HXT. But look at this. It's a little bit less than about a penny and a half wide. Okay, so the cost of acquisition is essentially the same for both ETFs, despite one being $12 billion with 2.5 million in shares traded. But we can also see that on a management fee perspective, this ETF is also 3 times more expensive at 0.15% management fee. So when we're buying ETFs, we need to be looking at all these different factors on ETFs that effectively are doing the same thing to determine which one makes the same sense. If you recall, asset allocation, being in the right index or a strategy, is the key determinant of success. Well, then you have to determine what your cost is, and that's where this all comes into play for you, okay? Very important when you're using your iTRADE, looking at these things. And please, please, please look at these level 2 quotes. The only reason I say that is if I look at this ETF here, I can see here that I can execute 50,000, actually more than that, sorry, 487,000 units, right? And a huge amount of money at 22.3. I don't need to be concerned at all about this ETF not having the significant amount of depth to execute at a penny wide. If I look at something like preferred shares, again, we can see a penny wide, fairly easy to get into, but you can see that the depth of this liquidity starts to go up pretty quickly. If I want to do 10,000 shares, well, I'm going to be probably not at 93.9. I'm probably going to be closer to 99.4. Okay, so these are things to understand as you look at buying and selling ETFs. I'm going to return to our presentation here. So that's, in a nutshell, sort of what you want to be doing, and some other key execution trading tips you want to look at. Number one, you always want to use a limit order on both buying and selling, okay? Second most important thing in this presentation, if you learn anything, asset allocation, most important investment decision. By buying ETFs, always use a limit order, both on selling and buying, okay? The reason for that is very simple. The market can move very quickly, even between you putting in an order. So the idea here is you've determined a price you want to buy the ETF at, so put that price in. If it doesn't get filled, raise it, but at least you have control over how you're buying that, okay? And they're very easy to execute on the iTRADE platform. Use stop losses if you can, okay? If you can't afford to lose a certain amount of money on a strategy, put a stop loss in. That functionality can protect your downside. Again, if it moves back up or it bounces, at least you had the ability to control when you sold. You can always get back in if you need to, but it's better than sustaining a huge loss when you can't monitor your portfolio. Stay away from orders between 9:30 and 9:45 and 3:45 and 4 p.m. The reason for this is the market makers that I discussed earlier, who are rebalancing their own positions, they're going to be actively in the market and not worrying about their positions, not yours, okay? They're rebalancing their exposure. This creates a high amount of volume and volatility, and it can create pricing disruptions in ETFs. Unless you're some kind of day trader, there's really no reason for you to be in the market between 3:45 and 4 and 9:30 and 9:45, especially if you're a longer buy and hold investor. So I recommend putting in orders after 10 a.m. and usually before 3 p.m. To get the most efficiency in how you execute your order. Again, we went through that. Look at the market size and depths of ETFs on the bid offer to determine where there's a sizable bid offer and where you should transact. Okay, so in summary, some key areas here: asset allocation matters, diversification matter, fees matter. You're seeing a trend here. Active investing certainly has some advantages in certain areas. That would probably be on the fixed income side. So look, when you're looking at fixed income, look at a range of index and fixed income. And properly diversified ETF portfolios are possible and available. I suggest you look at some of the suggestions through iTRADE. You can also go to horizonsetfs.com. We have a range of model portfolios. You can go to any of our competitors, BMO, Vanguard. They also offer model portfolios you can look at to sort of give you a starting template on what would look like a diversified portfolio. These are ETF portfolios that are templates built by investment professionals. So you're definitely not alone as you go forward on this. And of course, you can always contact us at Horizons or your iTRADE representative. We love hearing from direct investors, and we love helping you on your journey to become a better ETF investor. So with that, I'm going to switch it over to Conleaf. And thank you very much for your time today.
Mark, that presentation was amazing. A lot of information, and I'm hopeful that that information can be used by our listeners in their investment journey. There were two questions, Mark, I'd like to provide you there. Right?
Perfect.
Excellent. So Patty indicates she's been reading articles about ETF markets being oversold. Any thoughts?
Yeah, that's not a question that has anything to do with ETFs. It has to do with when someone says oversold or overbought, they're referring to the asset class. So I would not attribute anything specific to ETFs. That's literally literature that's saying that, for example, equity markets are oversold, meaning it's a good time to get in. If someone says it's oversold, it's a good time to get in. But whether, again, let's go back to our asset allocation discussion, whether you buy an individual oversold stock in that sector, whether you buy a mutual fund that invests in that sector or an ETF, they're all going to have a similar sort of behavior pattern. So it has nothing to do with ETFs being oversold. It has to do with the underlying asset class being oversold. I hope that clarifies that.
Great, thank you. And one of the questions from Patty, why buy a dividend ETF when you can buy the same, or when you can buy the sum of the underlying stock?
Well, I would ask the question: how many stocks are you choosing to buy? I mean, it's a great question. Why buy the question is basically why buy the individual ETF versus the individual stock? Well, most dividend ETFs in Canada probably have between, I would say, 40 to 100 stocks. Okay, so you've got diversification across a range of sectors and stocks. I don't know how much money you have at your disposal. Certainly, if you have, let's say, an excess of $1 million, you could probably build a diversified dividend stock portfolio with that same kind of scale as an ETF, creating weights and allocations appropriately. But if you have a threshold below that, really what ETFs do is they give you diversification. So you're not doubling down on 7 to 12 stocks. Maybe you want to own 7 to 12 stocks. You've studied these stocks tremendously. You believe these are the stocks to be in. You think the individual security risk is low. Then please go ahead, buy those 12 stocks to the ETFs. But I think for most investors, they want to get the breadth of, let's say, 40 to 100 stocks. And in order to do that really in a cost-effective manner, if you were to compare the management fee that you pay for the ETF for that exposure versus costing out what it would cost to buy those stocks individually, I think you'll find that the ETF provides a much more liquid, simple, and lower cost solution. I don't have the math for me to prove that, but generally when people do ask me that question, that's certainly the case. What I will highlight, though, is you could be someone who really understands those stocks. And look, there's nothing wrong with owning your own concentrated portfolio of stocks, or even better, use your iTrade platform to create a core and explore strategy where maybe in your core strategy you've got a dividend ETF, which is giving you what we call your dividend index beta, but then you have those individual dividend stocks you're buying on iTrade that you like to hold in a greater proportion because you believe those stocks offer a long-term total return that's more attractive than maybe an individual ETF would be. So I hope that helps. It's a bit of a non-answer, but it hopefully gives you some guidance on my thoughts on that question.
Great. Thank you so much, Mark. So that's, I believe there's one other. Oh, Patty says thank you. And Prem also says thank you.
No problem.
Excellent. All right, so let's do a quick wrap-up then. Thank you so much, Mark. That was a great presentation. So what is next? So as mentioned, you can access the webinar recordings on our YouTube channel, or simply just email us at education at scotiaitrade.com if you'd like to request a copy of the recording link. Lastly, when you exit the webinar today, we're going to upload a short survey for you. Just ask if you spend a few minutes in letting us know how we did today, and also letting us know if there's any other suggestions you have for improving our educational offerings, or if there's a topic that we're missing out that you may want to hear more about. So please spend a few minutes on that survey. We'd be glad to hear from you. A couple webinars coming up on Tuesday, the 19th, just later on. We have a webinar from the market guys, short selling, one of the items that had been requested by our clients. So feel free to go on to the education tab and find the events calendar, log on for that webinar, the market guys, short selling. Additionally, the Montreal Exchange will be here to present an option trading mistakes to avoid. Mistakes to avoid when trading options. Tuesday, September 26th is the Montreal Exchange. So feel free to go on to our education tab on the scotiaitrade.com site and click on the events calendar where you'll find our list of upcoming webinars. So on behalf of scotiaitrade.com and the client education team, I would like to thank Mark Noble for an amazing presentation, great information, and I'd also like to thank you, our attendees, for being with us today. We hope that we'll see you again as we present new webinars, and we also hope that the information we're providing to you will help in your investment journey. So have yourself a very good afternoon, and thank you once again for being with us today. Enjoy.